So where can you invest in 2022? 1. Blue chip stocks. Blue chip stocks are shares of large, well-known companies that are household names, like Disney, Amazon, Johnson & Johnson, to name a few. These stocks are thought of as being reliable, safe, and able to weather economic downturns over the long term. To identify blue chip stocks, look at the Dow Jones Industrial Average. They have a proven track record, hence can add stability and reliability to your portfolio. If you have an S&P 500 or total market index fund, chances are you have good exposure to these stocks already. A blue chip index fund or ETF is a good way to start investing in these. The SPDR Dow Jones Industrial Average ETF Trust is one of the most popular blue chip funds because of its low fees. You can also purchase shares directly through your brokerage. In relation to stocks and investing, check out our Patreon at only $40 a month. You get foreign exchange trade signals, and our track record is down below. 2. Real estate and rates. Buying a property often requires upfront costs like down payment and closing fees, on top of any renovations you choose to make. There are also ongoing and perhaps unexpected costs, like maintenance, repairs, dealing with tenants, and vacancies if you decide to rent out the property. If home ownership isn't for you, you can still invest in real estate through real estate investment trusts, REITs. This allows you to buy shares of a real estate portfolio with properties located across the country. They are publicly traded and have the potential for high dividends and long-term gains. Part of the reason is you get access to properties, such as commercial real estate and multifamily apartment complexes, that might be out of reach for individual investors. On the flip side, dividend payments earned through REITs are taxed as ordinary income instead of qualified dividends, hence a higher tax bill if you invest through a taxable brokerage account. When you invest in a REIT, you're also inherently trusting the management company to scout income-producing properties and manage them correctly. You don't get a say in which properties the REIT chooses to purchase. But with that said, you don't have to deal with tenants, repairs, or find a big down payment to start investing. And if you can invest through a tax-advantaged account, the dividends could grow tax-free. 3. Certificates of deposit. Certificates of deposit, or CDs, are issued by banks and generally offer a higher interest rate than savings accounts. These federally insured time deposits have specific maturity time that can range from several weeks to several years. Because these are time deposits, you cannot withdraw the money for a specified period of time without penalty. With a CD, the financial institution pays you interest at regular intervals. When it grows, you get your original principal back plus any accrued interest. It pays to shop around online for the best rates. Because of their safety and higher payouts, CD can be a good choice for retirees who don't need immediate income and are able to lock up their money for a little bit. But there are many kinds of CD to fit your needs, and some you can still take advantage of the higher rates on CD. A CD works well for risk-averse investors, especially those who need money at a specific time and can tie up their cash in exchange for a bit more yield than they'd find on a savings account. CD are considered safe investments, but they do carry reinvestment risk. The risk that when interest rates fall, investors will earn less when they reinvest principal and interest in new CD with lower rates, as we saw in 2020. The opposite risk is that rates will rise and investors won't be able to take advantage because they've already locked their money into a CD. Consider laddering CD. This basically means investing money in CD of varying terms so that all your money isn't tied up in one instrument for a long time. It's important to note that inflation and taxes could significantly erode the purchasing power of your investment. One of the biggest downsides, however, is that CD aren't as liquid as savings accounts or money market accounts because you tie up your money until the CD reaches maturity, often for months or years. It's possible to get your money sooner, but you'll often pay a penalty to do so. 4. Short-term corporate bond funds. Corporations sometimes raise money by issuing bonds to investors, and these can be packaged into bond funds that own bonds issued by potentially hundreds of corporations. Short-term bonds have an average maturity of 1 to 5 years, which makes them less susceptible to interest rate fluctuations than intermediate or long-term bonds. Corporate bond funds can be an excellent choice for investors looking for cash flow, such as retirees, or those who want to reduce their overall portfolio risk but still earn a return. They can be good for risk-averse investors who want a bit more yield than government bond funds. As is the case with other bond funds, short-term corporate bond funds are not FDIC insured. Investment-grade short-term bond funds often reward investors with higher returns than government and municipal bond funds. But the greater rewards come with added risk. There is always the chance that companies will have their credit rating downgraded or run into financial trouble and default on the bonds. To reduce that risk, make sure your fund is made up of high-quality corporate bonds. But the best part is that they are liquid in that you can buy or sell your fund shares every business day. In addition, you can reinvest income dividends or make additional investments at any time. Just keep in mind that capital losses are a possibility. 5. S&P 500 Index Funds. If you want to achieve higher returns than more traditional banking products or bonds, a good alternative is an S&P 500 index fund, though it does come with more volatility. The fund is based on about 500 of the largest American companies, meaning it comprises many of the most successful companies in the world. For example, Amazon and Microsoft are two of the most prominent member companies in the index. Like nearly any fund, an S&P 500 index fund offers immediate diversification, allowing you to own a piece of all of those companies. The fund includes companies from every industry, making it more resilient than many investments. Over time, the index has returned about 10% annually. These funds can be purchased with very low expense ratios. This is how much the management company charges to run the fund, and they're some of the best index funds. This fund is an excellent choice for beginning investors because it provides broad, diversified exposure to the stock market. This is 100% a good choice for any stock investor looking for a diversified investment and who can stay invested for at least 3 to 5 years. An S&P 500 fund is one of the less risky ways to invest in stocks because it consists of the market's top companies and is highly diversified. Of course, it still includes stocks, so it's going to be more volatile than bonds or any bank products. It's also not insured by the government, so you can lose money based upon fluctuations in value. However, the index has done quite well over time. An S&P 500 index fund is highly liquid, and investors will be able to buy or sell it on any day the market is open. 6. NASDAQ 100 Index Funds. An index fund based on the NASDAQ 100 is a great choice for investors who want to have exposure to some of the biggest and best tech companies without having to pick the winners and losers or having to analyze specific companies. The fund is based on the NASDAQ's 100 largest companies, meaning they're among the most successful and stable. Such companies include Apple and Facebook, each of which comprises a large portion of the total index. A NASDAQ 100 index fund offers you immediate diversification, so that your portfolio is not exposed to the failure of any single company. The best NASDAQ index funds charge a very low expense ratio, and they are a cheap way to own all of the companies in the index. A NASDAQ 100 index fund is a good selection for stock investors looking for growth and willing to deal with significant volatility. Investors should be able to commit to hold it for at least 3 to 5 years. Like any publicly traded stock, this collection of stocks can move down too. While the NASDAQ 100 has some of the strongest tech companies, these companies also are usually some of the most highly valued. That high valuation means that they're likely prone to falling quickly in a downturn, though they may rise again during an economic recovery.